The financial market is a modern-day battlefield. It is a place where powerful emotions clash every single second. The two primary forces at play are fear and greed. These emotions drive decisions, creating the dramatic price swings we see on our screens. A trader enters this arena not with a sword, but with capital and a mind that must be sharpened. Without proper preparation, you are simply gambling, hoping for a lucky break against seasoned professionals. To succeed, you must understand that you are not just trading stocks or currencies. You are navigating a complex psychological landscape where every participant is trying to outmaneuver the other. This battle is won not by the boldest, but by the best prepared. To navigate this battlefield, you need a reliable map. The most fundamental map for any trader is the price chart. This is where you begin your journey. The language of these charts is written in candlesticks. Each candlestick tells a story of the struggle between buyers and sellers over a specific period. It shows you the opening price, the closing price, the high, and the low. Understanding candlesticks is like learning the alphabet before you can read a book. They are the building blocks of price action analysis. Without this basic knowledge, you are essentially blind, unable to interpret the signals the market is giving you. A strong foundation starts here, with this simple yet powerful tool. Once you can read individual candlesticks, you must learn to identify key landmarks on your map. These are known as support and resistance levels. Support is a price level where buying pressure is strong enough to halt a downtrend, at least temporarily. Resistance is the opposite. It is a price level where selling pressure overcomes buying pressure, stopping an uptrend. These levels are critical because they help you anticipate where the market might turn. Furthermore, you must learn to recognize trends. Is the market moving generally upward, downward, or sideways? Identifying the dominant trend is like knowing which way the river is flowing. It is far easier to succeed by trading with the trend than against it. Building this foundational knowledge is non-negotiable. Many new traders rush into the market, lured by stories of quick profits. They skip the learning phase, thinking they can outsmart everyone else. This approach almost always leads to failure. Imagine trying to build a tall skyscraper on a weak foundation. It is destined to collapse. In trading, your knowledge of the basics, candlesticks, support, resistance, and trends, is your foundation. Take the time to build it strong and deep. True mastery comes from a profound understanding of these core principles, not from a secret indicator or a complex strategy. Your initial focus should be on education, not profits. Talent can only take you so far on the trading battlefield. The true key to long-term success is unwavering discipline and consistency. A successful trader operates like a well-trained soldier, following a plan without letting emotions interfere. This means developing a trading strategy and sticking to it. Your strategy should define your entry and exit points, the conditions you look for, and how you will manage your trades. Consistency means you apply this strategy on every single trade, day in and day out. It is this repetitive, disciplined action that separates amateurs from professionals. The market rewards consistency, not sporadic moments of brilliance. You must commit to your process. A crucial part of this discipline is keeping a detailed trading journal. Every warrior studies past battles to learn from them, and a trader must do the same. Your journal is your record of every trade you take. You should log the entry and exit price, the date, the reason for the trade, and the outcome. More importantly, you should record your emotional state. Were you fearful? Were you greedy? Were you overconfident? By reviewing your journal regularly, you can identify your strengths and weaknesses. You can see which strategies are working and which are not. This process of self-reflection is how you truly learn and grow. It transforms your mistakes into valuable lessons. No warrior goes into battle without armor. In trading, your armor is risk management. This is perhaps the most critical skill you will ever learn. The number one rule is to protect your capital at all costs. Without capital, you cannot trade. This means you must never risk more money on a single trade than you are willing to lose. A common rule of thumb is to risk no more than 1 to 2% of your trading account on any given trade. This ensures that a series of losses will not wipe you out. It keeps you in the game long enough to let your winning strategy work. Proper position sizing is your shield against the market's unforgiving nature. Every trader will experience losses. They are an unavoidable part of the business. The difference between a successful trader and a failed one is how they perceive these losses. An amateur sees a loss as a personal failure, a blow to their ego. A professional sees a loss as a learning opportunity, a piece of feedback from the market. A loss can tell you that your analysis was wrong, your timing was off, or you broke your rules. By analyzing your losses without emotion, you can refine your strategy and improve your execution. Frame every loss as tuition paid to the school of the market. Embrace them as essential steps on your path to mastery. Once your foundation is secure, you can begin to learn the more advanced arts of technical analysis. This involves mastering chart patterns. These patterns are recurring formations on a price chart that can help predict future price movements. They are the visual representation of the ongoing battle between buyers and sellers. Patterns like head and shoulders, double tops and bottoms, triangles and flags can provide powerful clues about whether a trend is likely to continue or reverse. Learning to identify these patterns requires practice and a keen eye, but they can give you a significant edge. They are like recognizing an enemy's familiar battle formations, allowing you to anticipate their next move. To enhance your analysis, you can employ technical indicators. These are mathematical calculations based on price, volume, or open interest. They are not magic crystal balls, but rather tools to help you confirm your analysis and understand market momentum. For instance, the Relative Strength Index, or RSI, is an oscillator that helps you identify overbought and oversold conditions. It can signal when a trend might be losing steam and due for a pullback. Another popular tool is the Moving Average Convergence Divergence, or MACD, which helps you identify trend direction and momentum. These indicators provide an extra layer of information to support your trading decisions. Another powerful toolset comes from the work of Fibonacci. Fibonacci retracement levels are horizontal lines that indicate potential support and resistance levels. They are based on key numbers identified by the mathematician Leonardo Fibonacci. Traders use these levels to pinpoint where a market might reverse or stall after a strong move. When a price is pulling back within a trend, it will often bounce from one of these Fibonacci levels. Using these tools can help you find more precise entry and exit points, improving the risk-to-reward ratio of your trades. They add a layer of mathematical harmony to the chaos of the market. However, a word of caution is necessary. It is easy for new traders to become overly reliant on these tools and indicators. They start searching for the perfect indicator that will never be wrong. This is a trap. Remember, indicators are derivatives of price. They follow price. They do not lead it. Your primary focus should always be on the price action itself, the candlesticks and the chart patterns. Use indicators as a confirmation tool, not as your primary signal generator. A warrior masters his weapon. He does not let the weapon master him. Learn the principles first, then learn how the tools can support those principles. The ultimate goal in trading is not to predict the future with perfect accuracy. No one can do that. The goal is to be so well prepared that you can react calmly and decisively to whatever the market does. It is about developing a robust plan that has a positive expectancy over many trades. You are not trying to win every single battle. You are trying to win the war. This requires a shift in mindset from trying to be right on every trade to focusing on executing your plan flawlessly. Victory belongs to the trader who has done the homework, knows their strategy inside and out, and has the discipline to follow it. This journey from novice to master is a marathon, not a sprint. It requires patience, persistence, and a genuine passion for learning. You must dedicate yourself to continuous improvement. The market is constantly evolving, and you must evolve with it. What worked last year may not work this year. The traders who survive and thrive are those who remain humble students of the market for their entire careers. They are always reading, always studying charts, and always refining their approach. They understand that their education is never truly complete. There is always more to learn, another layer of understanding to achieve. Every moment you spend studying charts, reading books, and reviewing your trades is an investment in your future success. This preparation builds the mental fortitude required to handle the psychological pressures of trading. When you have a solid plan and trust in your preparation, you are less likely to be swayed by fear or greed. You can execute your trades with the calm confidence of a seasoned professional, knowing you have an edge. This confidence does not come from arrogance, but from a deep well of knowledge and practice. You trust your process because you have built it and tested it yourself. In the end, victory on the trading battlefield is a direct result of the preparation you undertake before you ever risk a single dollar. It is earned through long hours of study and deliberate practice. It is forged in the discipline of following your rules and the humility of learning from your mistakes. Do not look for shortcuts or holy grails. Instead, commit to the process of becoming a true student of the markets. Build your foundation, master your tools, and manage your risk with unwavering discipline. The path is challenging, but for those who prepare for battle, the rewards can be immense.